HSBC also announced today that you're considering a special dividend once this $10.1 billion sale of HSBC Canada is completed. A share buyback may also now be in the mix. So, Noel, what information can you give us on that, and why is this the best use of proceeds now?
Well, we're seeing good growth prospects for our franchise going forward. Clearly, there are some economic challenges in the near term, but over the medium term, we see our international franchise having good growth prospects in transaction banking, international wholesale banking, wealth management. That allows us to be confident about our 12% plus ROTE in 2023 and 2024 and beyond. That therefore should generate for us good capital generation capacity, and that will allow us to consider buybacks and dividends at a higher level than we've seen in recent years. But also with a 50% payout ratio, it allows us to have sufficient capital to fund growth as well. So I think it's a combination of growth, but also at the same time, capital generation, facilitating additional dividends and buybacks. And with respect to the special dividend, we've got to wait for the transaction to complete. But a first priority use for me and for the board is to make sure that we pay a special dividend of 21 cents, subject to regulatory approval and subject to the transaction closing on Canada. But that would be our first use of funds. Thereafter, we'll consider how much should go as additional buybacks over and above our normal buybacks, and how much should be retained for use within the business. But we'll make that decision once the transaction closes.
Also, with regards to the dividend, can you give me a timeline on when you expect that dividend to get back to pre-COVID levels?
Well, if you do the maths on a 12% plus return in 2023 and a 50% payout ratio, the maths get you to an answer of around about 50 cents of dividend in 2023, which is sort of pre-COVID levels. But the big difference on that 50 cents in 2023, if we deliver on those promises this year, is that 50 cents is on a payout ratio of 50%. The 51 cents we paid pre-COVID was on a much higher payout ratio because we were distributing a fixed amount of dividends relative to profits, and profits, if they fluctuated, the dividend didn't change. What we now is have a much healthier balance of return generation and yield for our shareholders, plus an ability to retain profits for growth. And if that growth isn't there, then we have buyback capacity as well. So I think what we're looking at now is a much healthier capital base and a much healthier profit generation than we saw pre-COVID.